Welcome to the Farming Without the Bank podcast, the show with a no BS approach to money, hosted by a farm strategy expert and authorized IBC practitioner. Join us as we get real and expose the flaws of traditional financial institutions in order to help farmers take control of their finances, create peace of mind, grow their wealth, and leave a legacy. Now, here's your host, Mary Jo Ehrman.
Hello, and welcome to today's podcast where we're going to be talking about cash. Is cash king or is cash queen? I like to call cash queen. This might get some of your feathers ruffled out there. I have always been told that cash is king, and I grew up believing that cash is king. If you want to see a miser, I am the miser. In fact, my kids call me Mr. Krabs. If any of you have kids out there and you've watched SpongeBob, you know who Mr. Krabs is, the super cheap guy that will pick anything up off the floor. So I may not pick any penny up off the floor, but I do wash Ziploc bags, and I am proud to say I will not throw them away until they get super stinky. Drives my husband absolutely insane. However, they're expensive. And I'm not going to throw them away just because we had some cookies in them or something. So I am the cash person. I was the cash buyer before I was introduced to this concept. And so I have had to do a lot of paradigm shifting in my thought process to get around the fact that it's okay to pay a little bit of interest to my life insurance company when I'm borrowing against my cash value. However, let's start by talking about why cash is not king, and why we are all led to believe that it is. So if you buy something with cash, you're going to buy maybe a depreciating asset. Maybe it's a tractor or a combine. Maybe it's a car or a vehicle or something. You gave somebody else money. And in exchange for that money, you got a depreciating asset. And I talked about this in my last podcast. And I already touched on it in my last podcast. And so I want to dig a little deeper today. So you gave me money, and I now have your money and you have the depreciating asset. Even if it's not a depreciating asset, if it's a cow that can maybe throw some calves, great. Now we made some money off that cow, hopefully. But what would be better even than cash? Cash flow would even be better. So I'm going to stand out here and say cash flow is king and cash is queen. But let's just backtrack just a hair. If you have cash in savings and you buy that $60,000 vehicle with cash, you don't have a payment, correct? No payment. You have a depreciating asset, but no payment. And that is what we like. We don't like to have payments. But if you read Becoming Your Own Banker, the book that started it all for me, Nelson talks about in that book, and I talk about in my book, how you should be paying yourself back and you should be an honest banker. Meaning, if you took $60,000 out of your savings account to buy a vehicle, you should pay yourself back that $60,000. If you went to the bank to borrow money, you would have been happy to give them money. If you would have borrowed money from a lender at the car dealership, you would have been happy to pay them interest. So why not pay yourself back plus interest? Right? I'm going to just pause for 1 second so that sinks in. Pay yourself back plus interest. Even if you do not use my concept, that is one thought process that would create more wealth in this country than what we have today. If we were just all honest bankers and saying to ourselves, I, Mr. Banker, am going to lend myself money at 5% interest, and I'm going to pay it back. And if I can't afford to make that payment, I am not going to buy it. Or maybe I'm going to stretch that payment out a little bit longer because I, Mr. Banker, am easy to deal with. So we are putting extra money back into our savings account. all this is forced savings. I am not going to sit here and tell you this is some amazing strategy where money just shows up. It's a forced savings account, but it is a thought process that we are not taught to think about. Be an honest banker. Those of you that are savers anyway, if you're buying a $60,000 vehicle with cash, you most likely saved up to put that money there. Well, if you saved up to put that money there, you were putting money into a savings account every month anyway, and it was called a deposit. So why would you not keep making a deposit, just now referred to as a payment for the loan you took from yourself? Right? Now we're going into a deposit versus a loan repayment. They act the same. It's just that your deposit might be a little bit more because you have interest to pay back to yourself. Why would you pay interest back to yourself? That seems silly. Well, I'm going to ask, why wouldn't you pay interest back to yourself? You would pay interest to the bank if you had to, or you'd pay interest to another lender if you had to. Are you not worth as much as the bank? Absolutely you are. So you're going to want to pay interest back to yourself. The other reason you want to pay interest back to yourself is not just because you're worth it, but because you gave up the ability to earn interest as soon as you took that $60,000 out of the savings account. Now, let's just say that the bank is super nice and you found the most amazing bank in the city, and they're paying you 4% interest on any money that you have in savings. Well, guess what? The second you take $60,000 out of savings, you stop earning 4% on that money. You have interrupted the growth of that money. So if you're going to interrupt the growth of your money by taking money out of savings, then you better at least pay back yourself at the same rate or more, because it's not compounding now, than what you were being paid to begin with. So that leads us to compounding interest versus uninterrupted compounding interest. Ooh, that's a fancy term. Uninterrupted compound interest. When you take money out of savings, like I just said, you interrupted it. It stopped. It went to zero. It went from 60 to 0 in 10 seconds. And now you had to start over by paying yourself back into your savings account, putting deposits back into savings, whatever you want to call it. You had to start over from 0 to get back to 60. That whole time, you lost the ability to earn any interest because you took it out. What would happen if you had a tool where you just borrowed against it and it continued to earn you the 4%, and you were still able to buy your vehicle? That is why we use dividend-paying whole life insurance, is because we borrow against our policy and we use the life insurance company's money. Our money continues to stay in there compounding uninterrupted because it never leaves the account. It is used as collateral. So let me give you an example. I had a client that told me they paid $65,000 for a building. They paid cash instead of putting it into their policy and borrowing against their policy. So I said, let's look at the true cost of that building. Because your money never made it to the policy, it's not allowed to earn 4%. So now your $65,000 building over your lifetime, should you die at 87, would have been $394,000 of compound interest that would have been earned on that $65,000. So they lost $329,000 of interest. Now, I didn't figure in dividends because we have a dividend-paying company, right? So I didn't figure in dividends. This is just uninterrupted compound interest. So their $65,000 building truly cost them $329,000. So I said to them, well, if you paid cash for the building and we didn't get it in the policy, that's okay. But are you going to pay yourself back? And they said, what do you mean? Well, you borrowed $65,000 from yourself. Treat it like a loan. If you would have went to the bank to build your $65,000 building, you would have had to pay them back. So make this part of your operating cost as a payback. I don't care if you pay that building off over the next 20 years. Doesn't matter to me. Just be honest and pick a time frame and make that part of your operating cost. Put it in your operating expenses that you did a loan to yourself and you now have to pay yourself back plus interest because you lost the ability to make that interest inside the policy, or you lost that ability to make that interest inside a savings account. A lot of people compare this to borrowing against a CD. What if I would have $65,000 in a CD? Now, when CDs are paying a whole lot of money, people borrowed against their CD. They would give their CD to the bank and, here, Mr. Banker, here's my $65,000. You pay me 4% in the CD, and I'm going to go to the loan officer across the hall, and I'm going to borrow $65,000 from them, and we're going to use my CD as collateral. It is the exact same concept of what we're doing with dividend paying whole life. It's just that the life insurance company is handling that transaction rather than the bank. The other huge factor here is if you give the bank $65,000 to put in a CD, who gets the dividend from any profits of the bank? The dividend comes to the bank owners, to the board of the bank, right? So the owners are the ones, or the board, however it's set up, they're the ones that are going to get the dividend, not you. And again, I refer you back to Becoming Your Own Banker in R. Nelson Nash's book, and he compared the two and said, okay, if I use life insurance, this is what happens. If I use a bank, this is what happens. And who won was the cash value life insurance, because I work with a dividend company, a dividend paying company, and guess what? The mutual company, I'm part owner, so I get those dividends back to me rather than that going back to the owners of a company that I'm not part of. And so cash is not king, as we're led to believe. Because when we talk about cash being king, we do not talk about the lost opportunity cost on that money and what it could have grown for us and could have done for us. When we talk about compound interest in a 401k or an IRA, we don't talk about uninterrupted compound interest. When the stock market looks a little bit like a heartbeat, up and down and up and down and up and down, we're always starting over every time it drops. And we've interrupted the compounding of that money. So can we put our money somewhere where it's not going to be interrupted and we can continue to grow? And that is the key that we are teaching with Farming Without the Bank and the infinite banking concept. That is part of it. Obviously, it's not all of it, but it's part of it. And it's a big part of it because we need to find somewhere where we can leverage our dollar. And I said in the very beginning, cash flow is king. Yes, you heard that right. Cash flow is king. And that is one thing that I see with farmers, any business owner, but farmers especially, where we're buying something and the cash flow is going away from us rather than coming to us. Farmers will tell me that they're operating on cash or they're buying equipment with cash, especially when corn was $6, $7 a bushel. So now we've got all this money coming in and we have all this cash flow. So what did we do? We went and bought things where the cash flow that we had then turned around and went back out to John Deere Financial or Case IH or Caterpillar or whoever it is that you're buying your equipment from. And today, when the markets are lower, we still have the same amount of cash flow going out and not the same amount of cash flow coming in. Cash flow coming in and a large amount of cash flow coming in is what you want. The cash flow coming in allows us to make purchases. So you might think cash is king, but is it really? Because if you don't have the cash flow to buy something, you don't have cash to be king. You need that cash flow coming in. And that is what is so important and so missed in a lot of farming operations. I'm not going to say all of them, but a lot of them. I talk to a lot of people that do not know their cash flow. I ask 3 pretty basic questions when I meet with a client. Number 1, what are your total recurring operating costs? Recurring operating costs. I don't want anything amortized. I only want to know feed, seed, chemical, fertilizer, land rent. I want to know what those expenses are. They're recurring every single year. And then I want to know what your gross income is and your line of credit at the bank for your operating. I can tell you that the majority of my clients do not know those numbers. They might know their net operating or their total operating costs, but that's going to be land expenses that are going to come to an end, equipment that's going to come to an end, cattle expenses that are going to come to an end, those sort of things. Also, I see that a lot of people put in their living expenses. It doesn't take health insurance to operate per acre. I only want certain expenses. And that we have to know if our gross income is not higher or much higher than what all of our monthly expenses going out are, or our yearly expenses going out in your case, what happens? We're in the red. We really need to pay attention to your profit and loss and your balance sheet, and really pay attention to who's running your operation. Are you running it? Do you know the books, or are you allowing the accountant to run it so that he can save you money at the end of the year and you don't have to pay taxes? Or are you allowing the banker to run it based on what he gives you every year for money? You are solely in charge. And it should be really hard for you to be upset at the banker when he's not going to give you money if you don't know your cash flow. You need to understand that cash flow, because cash flow is king. And once you understand your books, it makes a whole lot more sense what's making you a profit, what's not making you a profit, and where all that money is going. Because you never have money. You are constantly using cash to buy something. You sell cows, you turn around, you use cash. You sell grain, you turn around, you use cash. You're pre-buying feed, fertilizer, chemical, whatever it is, you're pre-buying that for the year going forward. So pay attention to your cash flow and understand that that is far more important than buying things with cash. Because if you can put your money somewhere where you have uninterrupted compound interest, like a whole life insurance policy, you can borrow against it, pay some interest to the life insurance company, still have your money in your account earning you interest and dividends while you buy a piece of land, while you buy cows, while you buy a piece of equipment, while you buy a pickup, while you go on vacation. It doesn't matter. That is leveraging your dollar. No matter what you do with it, you're leveraging your dollar. You're either giving up interest to somebody else, or you're giving up the ability to earn interest. Nelson said that all the time. You finance every single thing you buy. You either give up interest or you pay interest to somebody else. So next time you think about cash, maybe you never think about cash. Maybe this will inspire you to think about cash. But next time you look at your profit and loss statement, next time you go to the banker, next time you go to the accountant, think about that cash flow, especially at the end of the year when the accountant is trying to save you money on taxes. Is it less cash flow out to pay the IRS for the taxes due, or is it more cash flow out to pay the bank for a piece of equipment that you amortized over 5 to 7 years? And in that scenario, who do you like more? The banker or the IRS? Most people don't like either, but they tend to go with the banker because they like the IRS a heck of a lot less. So instead of giving the IRS money, they're going to give that money to the banker, and you're going to give up control, and you're going to give up a little bit of your livelihood as collateral. or you may possibly give up a little bit of your livelihood as collateral. So really sit down and think about that. Cash flow is king, not cash. Cash flow. And you want as much cash flow coming into you as you possibly can have and the least amount going out. And that only happens when we understand where our books are, when we understand our payments on everything. And when we sit down and say, corn is $6 a bushel, and I can buy this piece of equipment at $6 a bushel, but I cannot afford it if corn would go to $3 a bushel. If you can't afford something at $3 a bushel, don't be buying it at $6 a bushel. We have to think long term as well. Chances are your accountant and your banker are not doing that. It is rare that I see either one of those two looking past a 12-month period of time. You have to pay attention to that. And then you will have cash flow. But do not be scared to put some cash somewhere that is going to earn you uninterrupted compound interest because you're leveraging your dollar. And that we have not been taught to do. Cash is not king. Thanks for tuning in. I hope that you guys have a great day. And if you need anything, you know where I'm at. You can always reach out. Thank you.
Thanks for listening to the Farming Without the Bank podcast. We hope today's episode has inspired you to take control of your finances in new ways. Don't forget to check out our website, farmingwithoutthebank.com, and engage with us on our Facebook page, Farming Without the Bank. Join us next week as we smash more financial myths and empower you to accomplish your financial goals.
Like the sound of Farming Without the Bank podcast? My audio production is provided by Podsworth Media. Check them out at podsworth.com.